Well, after Oracle's disappointing results, concern about an AI bubble have resurfaced. However, our next guest doesn't believe we are there at all. Let's find out why and explore what other risks and opportunities investors should be watching for right now. Joining us is Matt Kacur, president at FSA Valuation Service. Matt, thanks very much for joining us.
Hey, thanks for having me.
All right, Matt, I guess bubble is a four-letter word to you right now. Why is that?
Four-letter word. Well, I just keep hearing it over and over, and I just don't see it. I don't understand why we're being so, using a very harsh word. I mean, if someone came on a show like this and said, hey, it looks a little overheated, we're looking for a pullback, that seems a bit more warranted, and, I could believe in that, and I'd take that under advisement. But when you just start throwing out the word bubble, I mean, those are reserved for very extreme situations, and I just don't see it because I see a lot of real earnings, real revenue growth, real cash flow, really good metrics, return on capital, you name the metric, they're pretty good. Maybe valuations are a little rich, but overall I don't know how you can call this a bubble.
Is this a case of things are going so well that anything is a disappointment almost?
I think we've seen it in a couple of cases. I think Broadcom is a good example of that. And I have some stats if you want me to share them. But certainly it came out. I thought it was a very good quarter, and the market went down on the day, kind of trickled down after that. I mean, it might be bouncing a little bit today, but not too much. Yeah, if you can see the chart there, right at the very end of it is kind of the disappointment, even though it was really quite a good quarter. And yeah, I can go further. You want me to go a little bit further?
Yeah, no, please do. Please do.
There? Okay. So revenue was up like 28% year over year. EBITDA was up 31%. And those, to me, I use EBITDA over earnings. I just think it's a better metric. So we're growing there. It also beat the top and bottom line. And the stock was down actually 11% on the day. And I had 19%, but I think that was as of yesterday, so it doesn't include today's little bounce. But that's a muted reaction or even a poor reaction to actually quite a good quarter.
And a couple others you mentioned, NVIDIA and Advanced Micro Devices, two kind of different locations, though, you're saying.
Yeah, so let me go a little bit into detail there. NVIDIA on November 20th was their earnings, and revenue was up 62.5%. Now, I'll grant you can't keep growing at 62.5% all the time. But EBITDA was also up 61%, so margins are still pretty good. The stock dropped a little bit that day and then trickled down. That doesn't sound like a bubble to me, either on the financial performance metric side or that the market's getting overly heated either. So I don't see that. Advanced Micro, another example, a little bit different just on the timing, I think. They released their earnings a little bit earlier, and the stock had a monster move going into earnings from September 30th to, say, November 3rd, the day before the earnings. It was up 54% during that little, call it 1 month period, basically October. And then November 4th earnings were quite good. Stock bounced around for a few days, didn't really go down, didn't really go up, and then succumbed to market pressure and it's down 20%. And to me, by the way, also, was it in a bubble back then and it's down 20%? Well, 20% is normal. Well, maybe not normal volatility, maybe a bit higher than normal, but it's certainly not extreme. Pullbacks happen. They're normal. They're, expected. I don't call that a bubble. So there's three good examples of I don't see the bubble.
So what do you do with all this then right now?
Well, for me, I'm kind of fully invested in those. So everyone's going to be a little bit different. If I was a little light, I think you could add here. They're down a little bit, start nibbling away. It's never a bad idea to do dollar cost averaging. I'd like to see people take full positions on these type of names. But that doesn't mean, go out and buy it all at once, So I think if you dollar cost average it, if you're fully invested, I think you're holding and waiting to add on a bigger down than we're seeing now.
And I want to talk a little bit, you call them anti-AI stocks.
Yeah. So there's a lot of narrative out there. I would say mostly kind of software companies. So my example in that one is Adobe, but there are other ones too. Adobe's been absolutely killed for the last 2 years, basically on the narrative that, some competitors, of course, but you can reinvent this kind of software pretty easily with AI. That's the narrative out there. I think it's overdone personally. I just, I think Adobe's a fantastic company. The results keep coming in. Nothing's really changed results wise. They keep growing at 10%, bottom line growing roughly the same. So I don't see it there. I think this is more of an opportunity. If you had like a 2-year chart, it's really bad. I mean, let's see, you've got your chart up here. This was a $600 stock, and it's now what, 350 roughly, let's say. And it's just saying, oh, AI is not for them. Although, let's be honest, they're putting in, I'm sure they're investing in AI. I mean, maybe their offer isn't quite up to the same as some others, but they're going to be working on it. I think it can be an opportunity as much as a threat. So there's definitely a lot of movement, but I would say, it's going to, in the end, this is a cheap time to buy it.
Okay, we're going to have to wrap it up there, Matt, but thanks as always for joining us. All the best for the holidays.
All right. Thank you.
Matt Kacur is president at FSA Valuation Service.